Good afternoon, everyone. Today is Monday, the 14th of June, 2021, where we'll be discussing the other part of accounting for leases with respect to IFRS 16. And part one and part two are much more concentrated on the lessee's accounting. And the beginning of part three, we wrap up the lessee's accounting from the perspective of sales and leaseback. And we will conclude all of our discussion with accounting from the perspective of the lessor, vis-a-vis the disclosure requirement in line with IFRS 16. Okay, in that case, we switch to our note board. We'll start our discussion today with sales and leaseback. Transaction. What do we refer to as sales and leaseback transaction? Is a transaction that involves the sale of a specified asset by a party to the contract with an agreement to lease back the specified assets for a lease term or period, which means the initial owner of the assets decided to sell the assets and immediately lease back the same asset from the buyer of that asset. But the question is this: is it all transactions? That somewhat involves the transfer of an asset with the agreement to lease it back will constitute a sale and leaseback transaction. That's the question. Is it all transactions that look somewhat as the transfer of an asset by a party to another with the intention of immediately leasing it back will be considered to be a sale and leaseback transaction? The simple answer here is no. Therefore, how do we address it? The main point is to address this question. What is the question? Does the transaction constitute a sale in line with IFRS 15. The answer to that question will guide us on if this transaction can be considered to be a sale and leaseback transaction under a lease contract. Remember, even though in another session, we will discuss extensively on the application of IFRS 15, which borders on revenue from contracts with customers, which tends to replace IAS 18, IAS 11. Now, our ability to answer this question, either as yes or either as no, would determine whether it constitutes a sales and leaseback transaction. And that is it. If the answer is yes, it is yes because it is considered that such transfer of the specified assets has satisfied the performance obligation in line with IFRS 15. Which means if performance obligation has been deemed to have been fulfilled in line with IFRS 15, such transaction that relates to transfer will be considered a sale. And thereby, the agreement to lease it back immediately after the sale will make the combined transaction to be classified as a sale and leaseback transaction. Otherwise, if the answer is no, it means the performance obligation in line with IFRS 15 has not been met. Hence, it does not constitute a sale and leaseback transaction. Rather, it is more of a loan securitization. And we're going to come to that. But where the answer was yes, the conclusion is that it is a sale and leaseback transaction. That is that. Now, simply put, is only when the transfer of the assets meets the requirement of IFRS 15. That is when we can say such an agreement to transfer asset and immediately lease it back constitutes a sales and lease back. Otherwise, if the performance obligation condition is not met in line with IFRS 15, such an asset that is deemed to have been sold in order to lease it back will be deemed to have been a securitization, which means you only pledge that asset as a means to borrowing loan from the other party. And as such, the asset will still be retained in the books of the original owner, while the money received with respect to that purported disposal of the asset will be treated as a loan in line with IFRS 9 as a financial liability and will be treated as such. Okay, but where our focus is on is the treatment we'll have given to it if it's a sales and leaseback transaction. And that is where our interests lie for now. Okay, any question before we move ahead here? Any question? Okay, in the absence of no question. Now, what is the accounting treatment for a sale and leaseback, since we have agreed that it's a sales and leaseback? Accounting treatment of sale and leaseback transaction. Now let's look at it. If the transaction satisfies the requirement of IFRS 15, as earlier identified by me, therefore, you are going to account for the transfer as a sale. And in that situation, what are the steps you need to carry out? Now, take note that the owner of the asset is the seller in this case, and simultaneously is the lessee. Why? Because you sold your asset first to another person, and you enter into an agreement with that same person to lease that asset back. But before we go into the accounting, can we just more or less brainstorm on what will have been the rationale for you to sell your assets that you know you need and you have to lease it back again from your buyer? What is the rationale behind it? What economic sense exists within that framework? What are you trying to achieve in this real sense? What could bring about an entity decide to sell its asset that is put into use and immediately lease it back from the purported buyer of such an asset? Why have you done such?
Most times it has to do with liquidity problem. When a company has issues with liquidity, that it doesn't have enough money to finance its operations, it can actually go into that kind of agreement. Then
that is one. What if it's not liquidity problem? What other things exist that might make you take such decision as a business owner?
Oh yeah, Ma?
Who else? Madam Grace, what would make a business sell its assets, what it needs in its administrative for administrative use, and still decide to lease it back? What will have been the rationale in the first place for you to have sold that asset off?
Perhaps maintenance cost is high.
And when you lease it back, won't you still maintain it?
I'm sure you enter into an agreement where the
landlord will maintain it. And the landlord will not factor that high maintenance in your lease, in your lease payment. Is the landlord not charity?
No. If it's an equipment, landlord will, it depends on the agreement you have with the lessor. The lessee has with the lessor.
Okay, now let's look at it from this angle. What if you have investment opportunity where if you invest this amount, the return you will have over a period of time will be enormous, but you don't have the cash flow. I decided to say, okay, this machinery, if we can sell it, even though we need it in our production, but what if you find somebody that will buy it and that person will lease it back to us, in which we'll be paying periodic renters? But at large, we will have gotten massive amount of money arising from the disposal for us to carry out another investment. What about that? There are a lot of business reasons for that. Another thing that could bring about that is that when temporarily you observe that there's a market abnormally, when there is a capital appreciation with respect to that asset, which you believe may not exist forever, and what you decide to do is to immediately sell that asset and take up that gain with the hope that as you lease it back over time, in the future, new technology or cheaper technology might come in which you can use to replace. There are many economic reasons for that. I don't want us to focus just on the accounting. And that's why I emphasize on us discussing on these other reasons or rationale for doing this. Now, having understood that, how do we proceed to accounting for this from the angle of the lessee, who was the original owner of the assets that has been sold? Now, the first thing you do here, as I've seen it here, is to, as a seller, you are to measure your right of use assets arising from the lease back at a proportion of the previous carrying amounts. What that means is that as at the point you decided to sell the assets, what was the carrying amount of that asset, which is your cost less accumulated depreciation less impairment. Now that kind of amount, a proportion of it is going to be recognized at your right of use of assets, which represent the rights you have retained as the seller, who is now going to be the new lessee in that situation. What then you need to do is that your carrying amount is obtained from your financial statement or from your books as at the point of disposal. Now, as at that point, you know that you have entered into an agreement to lease it back. Your lease payments, you have to obtain the present value. The present value of your lease payments as a proportion of the fair value of the asset, if that asset is to be sold at arm's length. Okay? And that also might be equivalent of your selling price of that asset. Now, once you do this, what you have gotten invariably is the value of the rights of use assets, which you have to recognize as a lessee in your books. Whereas you will have to recognize the carrying amount of your asset that was disposed of, which means you treat the initial asset disposed of as a disposal and you bring in the value of the right of use assets. Secondly, what you do is that as a seller, you only recognize a gain that relates to the portion that was transferred, which is the same thing as the portion that is not retained. Remember, this is the portion retained. The entire gain have to be divided into two. This is the entire gain, which means the fair value of the assets, which means probably the selling price, less the kind amount will have given you the entire gain, which will have deemed profit on disposal. But this is not going to be recognized in full. Why? Because a portion of it relates to the retention of the right to use the assets, while a portion of it relates to what has been transferred out. And therefore, what do we do? This total gain, we have to split it into two. Portion that is retained and portion that is not retained. And how do you determine portion that is retained? The portion retained is a fraction of this entire gain, which is the profit on disposal here, or what I call total gain, is a fraction of it based on the present value of the lease payment over the fair value of the assets. What you get here is a portion that relates to the retained, and that portion will not be recognized as gain in your profit or loss. Whereas the portion that is not retained, which is the portion transferred out, is going to be the balance. Remember, what you have as your profit on disposal here, which is your total gain, let me say it is 100. What we discovered here in stage 2 here, let us say in stage 2, it is 80. Therefore, 100 minus 80 will give us 20. That 20 relates to the gain on the right transferred, which will be reported in profit or loss. Why this portion that is retained will serve as a remeasurement, adjustment to the lease liability and the right of use assets. We are going to see that as we move on. Okay, but all what I've explained, we will demonstrate that understanding from the perspective of a question. Any question before we look at a practical scenario? Any question?
No, I do not understand this. Maybe by the time we do practical illustration, I'll get it, but I do not understand it properly.
Okay, be specific about what you don't understand.
The portion of the stage 2 of it. The total, yes, the stage 2, calculate the gain that relate to right of retain. I know how to get the total gain, but after that, I don't.
Okay, don't worry, when we model it, you see it clearly. Any other question?
Okay.
Any other question? Any other question? Okay, let me use this example to explain it further. Illustration. Now, can you read out this question?
Okay, on April 1, 2020X2, Wicton Co. bought an injection molding machine for $600. The carrying amount of the machine as at 31st March 20X3 was $500,000. On April 1st, 20X3, Wicton Co. sold it to Whitehaven Co. for $740,000, its fair value. Wicton Co. immediately released the machine back for 5 years. The remainder of the useful life at $116 per annum payable in arrears. The present value of the future lease payment is $700,000, and the transaction satisfies IFRS 15 criteria to be recognized as a sale. Required, what gain should Wicton Co. recognize for the year ended 31st March 2024 as a result of the sale and leaseback?
Okay. Look at it clearly. On 1st of April, this bought an injection molding machine for this amount. The kind amount of the machine was 500 when it was sold. Okay, now on 1st of April, that means this company, who is the owner of the machine, has only used that machine for 1 year and has only depreciated it for $100,000. That's why the kind amount was 500. Now, on 1st of April, 2013, the same person now sold the machine to another person for how much?
$740.
$740, which means, in principle, the total gain should be the difference between the selling price and the carrying what? Amount. It sold it for how much? It sold it for
740.
740.
Carrying amount.
And the current amount is given to us as 500. Sometimes you are the one to determine the 500 yourself, but in this case, they've determined it for us. Your understanding of IAS 16 should be able to determine what kind of amount is at any point in time. But we are saying that this 240 relates to portion retained and portion what? Transferred. Therefore, what ratio are we going to use? We now said the ratio, retention ratio, is the ratio of the present value of the lease payments to the fair value of the assets. Now, the question then is, what is the present value of the lease payments? Since you already know the fair value. Now, the lease payments, we can further on the question. Wicton Co. immediately leased the machine back for 5 years. The remainder of the useful life, which means 5 years is the remaining useful life, and he has leased it for that 5 years. Okay? And he leased it to pay how much? $160,000 per annum in arrears. Now, furthermore, the present value of the future lease payment was given. Now, in another case, they might not give you the present value. You already know the payment of 160,000 per year. Now, if you know the interest rate implicit in the lease, or you know the incremental borrowing rate, you can get the 700. But in this question, you've determined that 700 for us. Which means if I want to ask you now, what is the interest rate implicit in the lease? Or what is incremental borrowing rate? Is for you to use your model to work it back. We'll show that as time goes on. Now, they've given me this already. But let me show you how they got it. The 700 was given to us, which is discounting 160,000 back with the rate in year one, 160,000 back with the rate in year two, up to 160,000 discounted back to year five, which means the 700,000 was as a result of you discounting from year one to year five, the sum of 160,000 being a constant cash flow by the discount factor raised to power n. Now, the only thing that is unknown is the R, which is the interest rate implicit in the lease or the lessee incremental borrowing rate. Now, let me use our model to determine that. But we are not asking this question, but I'm just trying to use it to explain. Let's go to our model. Annual payments. Duration in years. Present value was given to us on a platter of gold. Therefore, what is unknown is the discount rate. $700,000. Duration 5 years. Sorry, 160,000. Duration 5 years. Present value 700,000. Okay, now we can just construct a simple table and say, year 1, 2, 3, 4, 5. My cash flows. My cash flows are the 160,000, which is constant. I need my discount factor. And I need my present value. Okay. Now, what's my discount factor? I don't know. I can just put 0% because I don't know what it is. 1 plus R, my discount factor is 0% because I don't know what it is, raised to power minus N. In this case, N varies along with time. I find my products. The cash flow multiplied by the discount. Okay. Now, this is 800. But we are told that the present value is 700. Therefore, what is the rate that will make the present value here to be 700? Remember, I told you you can use go seek. Using go seek, is for me to ask myself a simple question. I go to my data. I go to my what if analysis. I go to go seek and say, okay, I'm seeking a goal where this highlighted cell will equal 700,000. Given that I change the discount rate to what will make it equal 700,000. Automatically, I'm able to arrive at 5%. Then put it in approximately about 4.62% is our interest rate implicit in the lease. Alternative to that is that I can equally still get my discount rate straightforward using a rate function. Using a rate function means I don't need to plug this table. I type my rate, and what I need there, I can see it from my function bar. I needed the number of period, which is this duration. I needed the payment, which is a constant amount, 160. My present value was set to be 700,000. I put it in negative. There's no future value expected, and this is done in arrears. I'll put 0. If it's done in advance, I put 1, and I close it. It gives me my value, which is the same value if I expand it. Again, you can also use IRR. For it. If you are using IRR, you are asking yourself that if you come here, you now, if I want to use IRR, I'll say, okay, I'm comparing cash flow from year 0. Year 0 is now the negative cash flow of 700. So that is 700 I sold it for, but over 5 years, the remaining useful life, I'm paying back 160, which means at the end of the day, I've paid a finance cost of 100,000. The question then is, if net, this will be 0, what rate will make this 0? That is what IRR will do. And say, okay, IRR, I can open it and drag the function from period 0 to period 5. I can decide to guess, and I can guess not. And that gives me my value. I also expand it, and it gives me the same results. And therefore, invariably, this is what we've done to determine the interest rate implicit in the lease. Now we'll go back to this, even though we don't need it, but I just try to do that for knowledge purposes. Okay, this is to determine That is that. Any question here before I move further? But now we can go ahead with this, our retention, and determine it here. What's our retention ratio? It is the present value, which is 700, divided by our fair value, which is 740. What ratio would this give us if I use my calculator? Again, I might not put it in decimal if I want to get the exact figure. But let me just assume I want to put it in decimal. That should give me approximately about 94.59% retention, which means invariably gain retained as a result of the leaseback equals 94.59% of the total gain of 240. And that is 227,027. Why the gain? Resulting from transfer on sale is the difference between the total gain and the gain retained. What is that? 240 minus 227,027. And that is 12,973. Now, does it make more sense to you now? And now?
Yes.
Okay.
Okay, so, okay, it's clear now.
Now,
So look at the accounting aspect.
Now, this process we have taken is on the premise that what has happened is on the premise that this has happened. Let me highlight it. Read this, please. Can you read that, please? I highlighted it.
Okay, and the transaction satisfy the IFRS 5 criteria to be recognized as a sale.
But what if it has not? What if it does not satisfy that? What will have happened?
I don't know. I don't have the idea.
No, I've explained that. Can you read out what I've written here? Does the transaction constitute a sale in line with IFRS 15? If it is no, can you read out what I stated as no, yeah? Okay,
it means the performance obligation in line with IFRS 15 has not been met. Hence, it does not constitute a sale and lease back transaction. Rather, it's more of a loan securitization. Okay.
Loan securitization.
Okay.
Does that make sense?
Yeah, so if that's the case, then the whole profit, there's no retention of gain. Oh, it makes sense, but I just don't know. It's
Now, in that case, what you are going to do is very simple. You are not going to record any transfer of asset. The asset will still be in your books because the control still lies with you. And the money you have collected, as if you have sold the asset, will be treated as a loan in your books, which have to be repaid by way of the lease payment you are making, in line with the requirement of IFRS 9 for financial liability.
okay.
Which means I gave you my asset with the hope that I've sold the asset, and you gave me money, and I'm still going to be using the asset. What the standard says that if it has not satisfied the condition where control has moved away from me due to the fact that performance obligation has been satisfied, what then happened in that situation is that the asset is still with me. Nothing happened or changes in the book. I still retain it at its current amount. I continue to depreciate. The money I collected, I won't take it as revenue on disposal. I'll take it as a financial liability, which is a loan. And every time I pay that interest, I pay that principal amount. Please, can you mute? Anytime I pay principal amount, it is treated as a repayment of the loan. And there is already interest that is already implied or factored in that agreement. And that will be my effective interest rate. And that will take us back to the requirement of IFRS 9 on how do you treat amortized cost measurement for financial liability. Any other question? Now, I'll give you an exercise now that you guys will practice. Now, we'll model this exercise out, okay, and see what the result will be. I've sent it to your WhatsApp. I'm also going to copy it out here. Okay, can somebody read this question? Okay, can somebody read it?
All right, I will read. Sale and leaseback transfer is a sale at fair value and leaseback is a finance lease from lessor's perspective. Example, entity A holds a ship in a statement of financial position at a carrying amount of 8,000 CU. Entity A enters into a contract to dispose of the ship to entity B for its fair value of 13,000 CU. At the same time, entity A enters into a contract to lease the ship back from entity B for 20 years with annual payments of 900 CU payable in advance each year. The interest rate implicit in the lease is 5%, resulting in a net present value of for the annual lease payments of 11,777 CU. The lease payments are considered to be at market term. The transfer of the ship to entity B is determined to satisfy the requirement in IFRS 15 to be accounted as a sale.
Okay, thank you. Now let's put out the variables. What are the variables? Entity A owns a ship with a carrying amount. Is how much? 8,000.
We have fair value.
What do you say?
Fair
Entity
value.
A, no, I want to be picking it line by line. Entity A enter into a contract to dispose of the ship for a fair value of what?
13,000 CU.
13.
Right.
At the same time, entity A enter into a contract to lease it back for 20 what? Yes.
Yes,
Lease term?
20 years.
Yes. 20.
Annual payment. No.
And annual lease payments
900.
is how much?
900.
900. And take note, payable in what?
In
Advance.
advance.
Take note. Period of payment.
Of payment. Advance.
This one is in what? In advance. The interest rate implicit in the lease is 5%.
5%.
Next,
Net present value.
okay, they've given us this answer. I will assume that they didn't give us, we'll determine it ourselves. Okay. The lease payments are considered to be at market term. Take note, lease payments at market term. We are going to come to a situation where it's not at market term, which means it's at arm's length. The transfer of the ship to entity B is determined to have satisfied requirement of IFRS 9, IFRS 15. IFRS 15 requirements satisfied. Now, what can we do? The first thing is to determine the present value. We have to determine the what? The present value. What is our present value? Again, our present value, if you know the formula, PV, is the rate. What is the rate? 5%. What is the tenor? The tenor is what? Is it 20 years?
Yes.
sir. 20 years.
20. Payment is how much? 900.
900.
Future value is 0. Type, you have to be careful here. It is advance. Therefore, it's 1 period in advance. Have you? You
Yes.
put 1. If it's in arrears, it will be what? Is 0. Is that okay? I'll put 1. And once I do that, can you see what I've gotten? Can you see?
Yes, sir.
That is where they got this 11,777. Can you see it here?
Yes, sir.
Okay. Does that make sense?
Yes, it does.
Okay.
Yes.
If that is the case, to take it out of negative, I can just come and put negative in front, or I go back where I have my payment. Because they are payment, I can put them in negative. Therefore, to put it in positive for me. That is that. Okay. Let me put everything in Naira in that regard. Now, because it met the condition of IFRS 15, it will be treated as sale and what? Leaseback. Now, I'm only accounting from the perspective of the lessee now. Therefore, what will I do in this case? Is for me to first of all determine my right of use assets. Step 1. Okay, let me obtain the retained ratio. What is the retained ratio? Associated with leaseback. And what I need there is that retention ratio should equal my present value divided by my fair value. And what is that? This divided by this. And that gives me, what is the ratio it gives me? What percentage? It gives me this percentage. Okay, now, what is the next thing? Step 2 is to determine the right of use assets being a proportion of the carrying amount as at the time of the transaction. Therefore, the right of use assets, how do I obtain it? Is the ratio of my carrying amount multiplied by the retained ratio. And what is that? My carrying amount is 8,000 multiplied by what? 90.59. That gives me this value. Okay, take note, and I can put it in brackets. That is 8,000 multiplied by 90.59%. Now, what else? The third one is to ascertain what is the total gain on transfer. Total gain on transfer is a difference between the fair value and the carrying amount. What was the fair value? 13. The carrying amount was 8. End product. This was 5,000. Now, from there, step 4 is to determine the gain retained as a result of the leaseback. And the gain retained is our total gain multiplied by our retained ratio. And in that case, total gain in this case was 5,000. And the return ratio was 90.59%. In that case, what do we have? Product of the 90% and the 5,000. And that gives us this value. Step 5 is the gain resulting from transferred, which will be reported within profit or loss. It's for us to look for the difference between the total gain and gain retained. What is total gain? 5,000. Gain retained, 4,529. What is left is 49. And that brings us to the end. Now the question then is, how do we put the journal entry in this case? debit. Credit. Now, first, you derecognize the assets. What is the name of the asset? Ship. The ship is derecognized. When the ship was derecognized, what do? You credit the ship account with the carrying amount. What was the carrying amount? 8,000. Now, but in lieu of that 8,000, the right of use assets was to be recognized. And that is recognized by way of debit, which is 7,000. Now, this right of use assets has its corresponding entry to be the lease liability. This is from the lease liability associated with the right of use assets. Now, somebody will ask me, where is the corresponding credit entry here, debit entry here? I'm coming to that, you see it. Furthermore, there's a gain. That was not recognized in profit or loss, which is a gain that was retained as a result of leaseback. That gain will also be recognized within lease liability. This is associated with the gain retained. And that is the sum of 4,529. And what happened is that this ship you recognize 8,000 and you'll bring it to disposal account. I'll put it recognized ship. That's it. Now, part of this gain was a gain that will have resulted from the fair value. And what is that? You receive cash proceeds on sale. You receive cash of how much? 13,000. Therefore, you debit cash for the selling price and you credit disposal accounts. This is still disposal account, but the disposal account here is only bringing in the proceed from the sale. Now, technically, if you look at this disposal account, you net off 13,000 proceeds from 8,000 cost, is supposed to give you gain of 5,000. But out of that 5,000, you are not going to recognize 4,000. That is why you are removing it from that disposal account, which is supposed to be gain account, to increase your liability, because the asset you deem to have sold, you still have an obligation relating to it. And a portion of gain relating to that obligation shouldn't have been recognized immediately because it has not been earned. Therefore, what do you do? In that disposal account, you now recognize this is where the debit entry of this is coming to. You recognize in the disposal account associated with gain retained. How much is it? That is 4. At the end of the day, if you net it up and say, okay, what are the balances in each book? The balance here is this. This account is a single account. I can collapse it and say the net balance here is the sum of the credits less the sum of the debits. Now, you find out that this amount is close to what you have seen before somewhere. This 470. This 470 is what you have seen here. Now, bank balance right of use asset balance and the liability balance. Sum of the credit here. Sum of the debits. And that is it. At the end of the day, let all my credit balance be negative, the way you see it in modern trial balance, to separate debit balances from credits. At the end of the day, this is the old journal entry. When you sum them up, the trial balance agree. When you look at the balance, okay. Any other question? Any other question? Now, that is what we've seen in this case. All credit balances are negative. Yeah. Any question? Now, this is a typical model we've done for such a sale and leaseback from the perspective of the lessee. Any question here? Enaro, do you better appreciate it now?
Yes, I do. I open at the journal entries. So the journal entries, the right of use seems to be
Continue.
the right of use seems to be lower, yes, lower than the lease liability.
Yes. Why is it so?
Or it's about four. I think it's
Why is it so?
I think that the retention, the gain retention seems to be.
Yeah, because you have already received money in advance of a gain that you have not yet earned, which means the liability also contains unearned income.
Okay.
From the proceeds you have received, which you pay back over time by way of lease rentals or lease payments. Does that make sense to you?
Okay, yes, yes, sir.
Does it make sense now?
Yes.
That is it. Okay, now let me find another practical question. Okay, let's go back to our discussion. If you check everything we've done, we make a comment here. What is the comment? The lease payments are at market what? Terms. What if the lease payments are not at market terms? What happens? Let us go back.
And that is that is the interest rate implicit to be different than the, it should not be in the incremental rate. I think favorable terms of interest or something. Mr. Miwa.
Yes, I'm hearing you.
I said if it's not in market terms, that means the interest rate implicit in the lease is lower than the market. That is the lower. No, the interest rate is lower than the normal, the market terms of interest. I think that will be the case. So it's not be at arm's length. It will be on a favorable term.
Okay. Don't worry. Let's look at what the position of the standard is.
Okay.
There are two perspectives to it, and I want you to read it out. Can you proceed?
Okay. Transaction not on market terms. If the fair value of consideration for the sale does not equal the fair value of the asset, or if the lease payments are not at market rates, the following adjustments should be made. Any below market terms should be accounted for as a prepayment of lease payment. The shortfall in consideration received from the lessor is treated as a lease payment made by the lessee. Any this thing is.
Sorry, I think there's a technological glitch. Hold on. Okay, proceed.
Okay. So any above market terms are accounted for as additional financing provided by the buyer stroke lessor the additional amount paid by the lessor is treated as additional liability, not as gain on the sale. IFRS 16, paragraph 11B.
Okay. Now, I want you guys to brainstorm on this before, use this question, discuss it amongst yourself before I prefer solution to it. Now, where you have transaction that is not made at market terms is when you compare the selling price of that asset with what the fair value of the asset is. If they are not the same and they are materially different, in that situation, you say it is not at market terms. And in that situation, what do? You identify that the selling price, is it more than the market? If it's above the market, it means the amount you sell it above the market price is going to be deemed to be additional financing arrangement you have entered into. But if you sell below the market price, it means that you have not sold at a loss necessarily below the market price, but you have more or less prepaid part of your lease arrangement. And that will be treated as prepayment, which will be amortized over the lease term. But let's start with the first one, which is the above market terms, which is what you see most times. Now, in that case, can you read this question once again? The question is now complete. Can somebody read the question and let us look at what we'll do next? If we can model it. Who will read?
Sellers sells the building to buyer Lot Co. for 800,000 cash. The carrying amount of the building prior to the sale was 600,000. Lot Co. arranges to lease the building back for 5 years. Arrears. The remaining useful life is 15 years. The transaction satisfies the IFRS 15 criteria to be recognized, so will be accounted for as the sale and lease back. At the date of sale, the fair value of the building was 750,000. The interest rate implicit in the lease is 4.5%.
Okay, thank you very much. Let's see what we do. Let's switch to our model sheet. In our model sheet, can you see it?
Yes, sir.
Okay. What are we going to do in this case? Now, in this case, I change it one by one. What was the kind amount?
$600,000.
600,000. And the fair value was 750. Now, it was sold for how much? Selling price, which is for the first time different from the fair value. Is now how much? How much is that? 800.
800,000.
What is the lease term? 5 years.
5 years.
Annual lease payment, 120.
20.
Now, the period is in arrears.
Arrears.
Interest rate implicit in the lease is 4.5. What's wrong here? Okay, the lease is no longer at market terms, not at market terms. Why is it not at market terms? Because we have established here that the fair value, and the something's wrong there. It's not allowing me to highlight. Okay, the fair value and these are not the same. Let me see whether I can highlight it now. Okay, give me 1 minute to reopen or relaunch my Excel. But pending the time, let me switch back to the question. Okay, let me see whether it will work now. Okay, yeah, it's working now. Now, it's not at market terms because of this. Now, the next thing we need to do because it satisfies the requirement of IFRS 15 is sales and leaseback. Now, what is our present value? Now, we have to determine that. We'll come back here. Remember, we have modeled it before, but the only difference is that here, we put it as type 1 because it was in advance then. But now it is in what? Arrears. I'll change it to 0. And therefore, this is our present value because it's in arrears. Take note of that when you are modeling. Okay, arrears is 0, advance is 1. Now that is that. Therefore, what we do is that we have determined the present value first, and we can now go ahead to determine that 1, there is an additional financing, what's it called? I'll call it additional financing arrangements of How do I determine that? You sold the asset more than what the market is. That means that impliedly, you have more or less collected some money in advance, which you are going to repay as an additional amount to your lease payment in the future. Because the person that bought the asset from you knows that the asset worth 750, but bought it from you at 800. That person will have also factored in this 120, that excess amount. It's not a charity. And therefore, we are now saying that you cannot go ahead to recognize gain of additional 50,000. Rather, you recognize it as an obligation. And what is that obligation? Is the difference between your fair value and your actual selling price. Now, what is the excess? The excess will be treated as this excess will be considered additional financing arrangements, which means it will not be seen as additional gain to you. No, it's a liability. There's no free lunch in Freetown. Therefore, we'll come to that. Now, let's go ahead. What is our right of use asset? Remember, we determine our, let me call this step 1. I'll call this step 2. Therefore, my retention ratio will be step 3. What is my retention ratio? The present value, which is in step 1, divided by the fair value. Okay, and what is my present value? My present value is 526, Abi. But recall that there's something there, which I'm going to bring to your notice now. In this 526, there is this additional, or what I call excess. Let me call it additional financing arrangement. This additional financing arrangement is a deduction from that, which means this additional financing arrangement here, I have to reduce it from this to obtain the present value without that additional financing arrangement. And you see why. This is now the present value net of additional financing arrangements. And take note, that is what is relevant here. Let me put it here. Why? Because this 50,000 have to be backed out of it and warehoused somewhere. We are coming back to that. Now, which means what is relevant for me here is not 526, but 476. And you see why. What is my fair value? My fair value is 750. Therefore, that gives me 63.57%. Now, what is my kind amount? My right of use, which is step 4, will now be the carrying amount, which is 600,000 multiplied by 63.57. That is what gave me 381 as my right of use assets, which are to be depreciated over this lease term of 5 years. Okay, what else will I need to do? I need to determine my gain. Step 5. My total gain on the transfer or sales and leaseback is how much? It's 750. Remember, we are using fair value, not the selling price. The excess of the selling price over fair value, we have warehoused it somewhere here as 50,000. Take note, being warehoused. Take note of that. We'll come back to that and see what happens to it. Okay, and we'll compare that with our carrying what amount. Doing that gives me 150,000 as my gain on transfer. Therefore, step 6 will now be what portion of the gain is retained, which is the total gain, 150,000, multiplied by the 63.57%. And that gives me 95,360. Invariably, what happens? My gain, which I will actually recognize now, which is step 7. In my profit or loss from that transfer is the difference between the total gain of 150,000 and gain retained of 95,359. And that gives me 54,000. Now, what will you find out that I've done? Is that when you look at what we've done, at the end of the day, my liability here is showing 476, which is in tandem with this 476, but actually I've backed out 50,000. Where's that 50,000? You now find out that in my accounting entry here, the actual proceed is not 750. Therefore, what will I do? This was the proceed attributed to fair value and I'll now bring the proceed attributed to additional financing arrangements. This additional financing arrangement and that is 50,000. You know, I told you I warehouse it. And that also will increase my liability. Proceed. And that is this 50,000. At the end of the day, what will you find out? Let me show you the color. What that signifies is that our bank proceeds at the end of the day will be summed as follows. This is the sum of the debit minus the sum of the credit. Okay, the same thing, my liability will be the sum of these three items. Sum of the credit and a sum of the debit. Okay, and that is that. Now, the 50,000 I warehoused here is what I brought back as an entry to reflect that actually I collected 800,000 and my liability actually is this 526. Okay, and that is that, which means what we have only introduced is these additional steps, which let me highlight with my pen. These additional steps and that step brought about introducing this. And also introducing this. Does that make sense now?
Yes.
Any question? Okay. Any other question?
Okay. Let me ask this question. I can see these additional financing arrangements is as a result of increase in selling price. What are the conditions that a lessee would observe to prompt this increase in financing arrangements?
I don't understand.
As in the financing arrangement, you know, the sales price is higher than the fair value of the assets.
Okay.
But I just want to know, is it as a result of economic indicators, maybe exchange rates or anything that's caused these increments?
No. There are other factors that might cause it. The nature of that asset and the desire of another party to actually lay hand on that asset and buy it might be what has allowed the seller to add premium to it.
Okay.
You can say now.
Yes.
You know, there are sometimes that outside you can get the same thing you got in GRA, in Magodo, but probably you want preference for GRA because the nature of what you want to use it for will pay you more in GRA than in Magodo.
Yes.
Or you just have a preference, a bias, to say, okay, I prefer GRA than Magodo, or I prefer than Ikoyi because it's central. That might be other factors. There are thousands of reasons why, but again, you that you bought it for 800, when you know it is 750, and the person will lease it back from you, you too will have factored something in the rent because there's no free lunch in Freetown. That is why we felt that don't be rejoicing that you sold it to that person at 800, which is 50,000 above the market price. That person technically has built it back in his own rent, or will build it back in his rent. That's a presumption there. Does that make sense?
Yes.
Okay, now let me give you another exercise and see whether some of those principles we identify, you can resonate with them. Illustration. Can you look at this illustration? Who can read it out for us? Madam Grace, can you assist us?
Illustration. Capital Co. entered into a sale and leaseback on 1st April 2017. It sold a late with a carrying amount of $300 for $400,000. $300,000 for $400,000, equivalent to fair value, and lease it back over the 5-year period, equivalent to its remaining useful life.
Now look at this first. Equivalent to fair value means
market.
At market, everything tally, okay?
The transaction constitutes a sale in accordance with IFRS 15.
Thank you. Now, before then, who can tell me this phrase here? What value does it add, or will it add? This phrase here. And lease back over a 5-year period, which is equivalent to the remaining useful life. What this signifies is that even if you are not given the interest rate implicit in the lease, because the life to which you have leased it is equal to the remaining life, the fair value will be enough information for us to work back for the interest rate implicit in the lease. Unlike the last one we saw, which adds 15 years useful life, but this for 5 years. Therefore, the fair value will not be approximate, except if you have equivalent fair value for an asset of such a nature for 5 years useful life. Go ahead, ma.
The lease provided for 5 annual payments in arrears of $90,000. The rate of interest implicit in the lease is 5%. Using a discount factor of 5%, the cumulative present value of $1 payable annually in arrears for 5 years is $4,329.
That is the equivalent. That is the equivalent. This is the equivalent of the cumulative discount factor. That is, if you don't want to discount year by year, given that you have even cash flows, that is what you have. Okay, continue.
Required. What are the amounts to be recognized in the financial statement at 31st March 2018 in respect of this transaction?
Okay, that's very straightforward. Now let us switch to our model. I think it's exactly what we have done in this model. That's model scenario 9, okay? Now I'll just copy scenario 9. I'll move it Yeah, I'll create a copy, and that will be 11. Okay, let me change it and put the right question there. If this is a question, okay, now what will I change? The kind amount was 300,000. The fair value equal the selling price, which was 400,000. The lease term is for 5 years. Annual lease payments, how much is it? 90,000. And it is in arrears. Therefore, we must take note of that. That will affect our computation of present value. And interest rate implicit in the lease is 5%. Let me explain so that you don't make mistake of reading anything. And it's at market terms. It is market terms because the fair value and the selling price are the same. IFRS 15 is satisfied, therefore it's a sales and lease back. Therefore, the present value of 409 may not be correct. Why? Because when we come back to our formula here, we use 1, which is for arrears, whereas 0 is for 1 is for advance, 0 is for arrears. Therefore, I change it to 0, and therefore that gives me 389,652,000. Okay, now what do I do? Step 1, return ratio was 97.41%. Right of use asset is a fraction of the kind amount. The kind amount is 300,000. And the ratio is 97.41. And that's where we get this 292,000. Now, the total gain was 100,000, being the difference between the fair value and the kind amount, of which the gain retained is 97.4% of 100,000. Okay, now step 5. Gain resulting from the transfer is the difference between the total gain of 100,000 and gain retained of 97,413. The difference there is 2,557. Therefore, these are the journal entry as at when the transaction was consummated. Therefore, what they now want you to do is give us information about the asset with respect to what's it called? With respect to what you are going to show in your balance sheet at the end of the day. Now, what are you going to show in your balance sheet? For the right of use, that's step, that should be step 7. Carrying amount of the right of use assets as at 31st March 2018. This is step 7, journal entry. Step 6, sorry. Okay, now what I need is just very simple. My Naira. I needed my cost, initial cost, because that's the first year, and let my accumulated depreciation. But because it's the first year, it's only 1 year depreciation that will have passed. Now, what is my cost? My cost from the right of use asset here, which is this 292, less my depreciation. My annual depreciation will now be 292, 239.68 divided by how many years? 5 years. Remember, lease time. Therefore, I'll come here and say, this is this divided by 5 years. And automatically, I need to put that in negative, and that gives me my carrying amount, which I'll put in my balance sheet. Okay. That is that. Now, what else am I going to do is step 8, my amortized cost schedule for the lease liability. Let me go to one of the schedule where we have that schedule. Okay, I only need for 5 years. Let me copy it and come here. Therefore, I start with my opening balance. My opening balance for the liability, if you remember, is this my present value here, which is the sum of what I still got here. Okay, my interest rate implicit in the lease is 5%. Therefore, I change my formula to pick the 5% here. And I lock it. And I can run that one down. What is my lease payment? Each year, 90,000. And I run that down. At the end of the day, I've been able to construct my amortized cost schedule. But what matters to me is the kind amount as at the end of the year, which is this. Remember, our year runs from 1st April to 31st March. Therefore, in that scenario, as at end of each March, this is March of the first year, which is between 1st of April 2017 and 31st of March. I can put it here. First year runs from 1st of April 2017 to 31st of March 2018. Okay, let me put it here. I'll put it period. Okay. Therefore, instead of putting it inside there, I'll put it here so that every year it runs. Okay. Let me assume that that's how it runs. I'll run it down. This 18 to 19. This 19 to 20. This 20 to 21. And this 21 to 22. Okay, that is that. Now, what is relevant to me is this. Now, that color is too. Okay, what's relevant to me is 20 as at 31st of December 2019, which is a question, 2018, which is a question. Now I have to split it into a portion into current portion and non-current portion. Current portion is the difference between, if you remember, the liability as at end of this year and the liability as at end of next year expected for next year, all things being equal. And since the total liability is this, current portion will be the balancing what figure. It will be the difference between the balance and that's that. Remember, current portion is balance in period N minus balance in period N plus 1. And this is the balancing figure. Now let's look at it. Okay. And this is a balancing figure. That is that. Now, that is what we've done. Now, let us show our balance sheet extract. Or let me start with statement. Let me put it as income statement extract. For the year ended 31st March 2018. What are you going to show there in Naira values? Are things like in administrative expenses, you show things like depreciation, or if it's something that goes into your cost of sales, What's our depreciation for that year? Under other income or other gains, you have gain on sale and leaseback assets. What was our gain? Gain transferred, that's the 1,500. What again can we have? Okay, under our finance costs, or cost, we have our interest implicit in the lease. And what was that? It's an expense. That's in 19, that period. And that is that. Now, at the end of the day, the whole impact in profit or loss is the sum of this. Net impact is of expense. Now, balance sheet extract. As at year ended, under assets, you have non-current assets. You have rights of use assets. The kind amount is this. Okay, you don't know what your bank balance is because it might have changed over time. Under liability, you have non-current liabilities. You have lease liability. That's the non-current portion. How much is it? You now have the current portion. Okay. And that is it. Any other question? These are our extracts as at the end of the year. Does it make sense to us? Does it make sense to us?
Yes.
It makes sense.
Okay. Okay. Now, let's go back to our work note, which means we've demonstrated understanding of this. That is, we've demonstrated understanding of above market terms, and I've told you if it's below market terms, what we are going to do is that the shortfall will also be warehouse, but will be treated not as an expense, which is a loss, but will be treated as a prepayment. And what happened to a prepayment? You amortize the prepayment over the remaining useful lease term, amortized over the lease period. Does that make sense to us? Okay. Any other question? Now, lessor's accounting, which means how will the lessor have accounted for the lease arrangements? The first thing we need to understand is that unlike accounting by the lessee, the position of IAS 17 is still the same or similar to that of IFRS 16 with respect to lessor's accounting. And that area speaks to the fact that IFRS 16 equally require the need to distinguish between a finance lease and an operating lease from the perspective of the lessor. The lessor is the supplier of the assets that is in use during the period of the lease. And such, before the lessor can proceed in accounting for the lease, the lessor needs to establish, based on qualitative factors, whether the lease is a finance lease or an operating lease. Now, what is a finance lease as opposed to an operating lease from the angle of the standard? Let's look at the following terminologies. A finance lease is a lease that is considered to have substantially transferred all the risk and reward associated or incidental to ownership of the underlying assets or specified assets. Which means if evidence is shown to have revealed to us that as a result of the lease, it is deemed that the supplier or the owner of the specified asset has transferred substantially the risk and reward incidental to ownership to another person, which is the lessee. In such a situation, the lessor will have classified such a lease as a finance lease. And take note, the risk we are talking about here is nothing other than risk associated with the use, control, and benefits relating to that asset, not any other form of risk, but risk incidental to the use of that asset, to which it may affect the economic benefit associated with the asset to the benefit of the lessee in that case. Secondly, if it's not a finance lease, therefore it is an operating lease. And the standard went further to define operating lease as a lease that does not transfer substantially all of the risk and reward incidental to the ownership of the underlying asset, which means any lease that does not meet the definition of a finance lease automatically will be considered as an operating lease. That is key to us. And that is what we need to take into consideration. Now let's come back here. What is the key consideration here? In a finance lease, what happened is that the lessor will have to recognize the asset in his book and replace it by recognizing lease receivable in his balance sheet. And that will be recognized based on the net investment in the lease. And over the lease term, it will recognize finance income by way of actuarial method to unwinding the interest embedded in the lease as an income using the constant periodic rate of return, which is like an actuarial methodology. Whereas the cash received by way of lease payments from the lessee will be used to reduce the outstanding lease receivable in the book of the lessor. And that is a treatment we give to finance lease from the perspective of the lessor. Conversely, if it has been classified as an operating lease, the assets will still be carried in the books of the lessor, the way it will have been carrying it prior to the lease, which will be in line with the requirement of IFRS 16, if it's an item of PPE, or if it's much more related to an item of investment property, and in extreme situation may affect an item of intangible that can be considered separable. But in this instance, what happens if it's an operating lease? The asset is continuously carried in the books of the lessor and depreciated accordingly, and likewise subjected to impairment as deemed fit. And the depreciation will only take cognizance not of the lease term, but will only take cognizance of the useful life of the asset. And at the end of the day, the lease payment will be recognized over the lease term on a straight line basis as an income to match the associated cost, which is the depreciation. Which means accounting for operating lease is as straightforward as ABC from the perspective of the lessor, which means money you receive in advance, if any, as the whole sum of money relating to that lease, operating lease will be amortized on a straight line. And if it's what you receive in arrears, you accrue for it as income as at when it falls due. Whereas the asset is continuously carried in your books at cost, subject to various model, impact of various model, and you depreciate it over the useful life of the assets and subject it to payment test in line with IAS 36, as the case may be. And that is that. Now, before we proceed, I want us to look at some critical terminologies other than what I've explained earlier. Can somebody start from the guaranteed residual value?
Okay. Guaranteed residual value is A, for a lessee, that part of the residual value which is guaranteed by the lessee or by a party related to the lessee. The amount of the guarantee between the maximum amount that could in any event become payable. B, for a lessor, that part of the residual value which is guaranteed by the lessee or by a third party unrelated to the lessor who is financially capable of discharging of the obligation under the guarantee.
Okay, continue.
Unguaranteed residual value. Unguaranteed residual value is that portion of the residual value of the underlying assets, the realization of which by the lessor is not assured or is guaranteed solely by a party related to the lessor. Gross investment in the lease is the sum of A, the lease payments receivable by the lessor under a finance lease, and B, any unguaranteed residual value accruing to the lessor. Net investment in the lease. Net investment in the lease is the gross investment in the lease discounted at the interest rates implicit in the lease. Unearned finance income. Unearned finance income is the difference between A, the gross investment in the lease, and B, the net investment in the lease.
Okay, we are going to demonstrate our understanding of this, looking at practical illustration. Okay, now let me explain one further. If you check here, we define guaranteed residual value from two perspectives. If you remember, we have defined it before now under the lessee, and it's not different from what we are seeing now. That from the perspective of the lessee, it is a part of the residual value which is guaranteed by the lessee or somebody that is related to the lessee, probably his parent or associate. And the amount is guaranteed as the maximum amount that will be paid if the lessee decided to exercise option to take over the asset after the lease period or lease term. Now we are defining it from other perspective, which is the perspective of the lessor for the first time. Now you see that is exactly opposite of what we have discussed about the lessee, which is from the angle of the lessor, it is a part of the residual value that is guaranteed by the lessor or third party that is unrelated to the lessor. Because if that party is related to the lessor, it's like you are paying yourself back. That should not have been taken into consideration, which means it must be an independent person who has relationship with the lessee, or if it's the lessee itself that has guaranteed such an amount. That is when the amount will be considered a guaranteed residual value. And it plays its role if you go back to what we discussed. Now, if you go back to our initial discussion where we try to obtain interest rate implicit in the lease, you find it here that we define the relevance of that guaranteed amount. Now, remember here we said the lease payment is key. And the lease payment here plus the unguaranteed. But we are talking about guarantee. Where is the guarantee? The guarantee is a component of the lease payment, which when you come here, you see what we talked about, guaranteed residual value here, which is a component of the lease payments, which is this. Take note of that. Now let's move further. That is that. Now, the unguaranteed residual value, which is what I also showed you earlier, is the portion of the residual value of the underlying assets of which the realization by the lessor is not assured and it's not guaranteed solely by the party related to the lessor, which means is a portion that might be retained as a residual value given that the option to purchase was not exercised or the asset will not transfer to the lessee at the end of the lease term. Now, next to it is the gross investment in the lease. The gross investment in the lease is the sum of all payments receivable by the lessor from the lease. And this is only relevant to finance lease. Now, plus the unguaranteed residual value, which means this is an undiscounted amount. Total value incidental to the lease. But for accounting purpose, what we recognize is the discounted amount. The discounted amount is the gross amount which has been discounted at the interest rate implicit in the lease. From the angle of the lessor, incremental borrowing rate of the lessee will not be relevant because the lessor knows what is the rate of return he has factored in the whole process of this lease. And therefore, issue that borders on incremental borrowing rate from the angle of the lessee will not be relevant. Now, finally, the difference between the gross investment in the lease and the net investment in the lease is our unearned finance income, which is only relevant for disclosure purposes. And we're going to see it as we move on. Any question on that? Any question on that? Okay, the next order I want to look out for is how do we distinguish between a finance lease and an operating lease? You carry out a test from the perspective of the lessor. And the test is to establish, like an hypothesis test, is to reject the concern that is a finance lease, which means your inability to reject the concern that is a finance lease will now make us reach a conclusion that this is a finance lease. Now, what is it? Can somebody read this up? What are the attributes of a finance lease?
Okay, primary factors or indicators, attributes of a finance lease. The lease transfers ownership of the asset to the lessee by the end of the lease term. The lease transfers ownership of the asset to the lessee by the end of the lease term, that's one. The lessee has the option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date. At the date option becomes exercisable, such that at the inception of the lease, it is reasonably certain that the option will be exercised. The lease term is for the major part of the economic life of the asset, even if title is not transferred. At the inception of the lease, the present value of the minimum lease payment amount to at least substantially all of the fair value of the leased assets. The leased assets are of such a specialized nature that only the lease can use them without major modification. I think only the lessee, that's what you want to do there. Only the lessee can use them without any major modification. Secondary factors or indicators. If the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee. And gains and losses from fluctuation in the fair value of the residual fall to the lessee. The lessee has the ability to continue the lease for a secondary period at a rent that is substantially lower than the market rate. Okay.
Okay, these are primary factors and secondary factors that serve as indicators to determine if it's a finance lease. If the combination or one or two of these are not met, automatically it will be defaulted as an operating lease. Okay, now let's look at some other considerations.
Sorry,
yeah.
Sorry, let me just ask, these indicators, do you need to have most of them or just one of them is okay?
I said one or two or more in substance is what you consider. Okay. Not that all of those conditions must be met, no. Materially, once you see evidence of one or more of these in combination, it's still towards you recognizing such a lease as a finance lease. For example, if the useful life of an asset is, let me say, is 10 years, and you as a lessor is leasing it to somebody for 9 years, that is a substantial part of the life of the assets. That should, by all factors, should be considered to be a finance lease. Or if the present value of the minimum lease payment or lease payment you are going to receive is a major part of the fair value of the assets. Probably it represents like 80%, 75%, 90% value of the asset. It is much more tilted towards being recognized as a finance lease. In practice, you should be able to know easily. It's only in extreme situation that you might sit at a borderline. And that's why you now consider other factors, including secondary factors, to establish it, which means you can more or less develop a checklist that will always guide you towards appropriate classification of the lease as a lessor. Okay, now I want you to expatiate further on what finance lease is all about.
Okay. A finance lease is a lease that transfers substantially all the risk and rewards incidental to ownership of an underlying asset. It can be considered to be like hire purchase, a form of installment credit. When we talk of risk here, we specifically mean the risks of ownership, not other type of risk. Risks of ownership include the possibility of losses from idle capacity or technological obsolescence, or variation in return due to changing economic conditions. The rewards are represented by the expectation of profitable operation over the asset's economic life, and also any gain from appreciation in value or realization of a residual value. IFRS 16 paragraph B53. For lessors, but not lessees, finance leases are distinguished from operating leases.
Thank you. That corroborated all what I've explained earlier. Now let's look at accounting treatments. For a finance lease. I've explained it earlier, but let's break it down here. And where necessary, we'll model it. Okay? Can you assist us? Yeah.
Okay. Accounting treatment for a finance lease. IFRS 16 requires the amount due from the lessee under a finance lease to be recorded in the statement of financial position of a lessor as a receivable as the amount of the net investment in the lease. The recognition of finance income under a finance lease should normally be based on a pattern to give a constant periodic rate of return on the lessor's net investment outstanding in respect of the finance lease in each period. In arriving at the constant periodic rate of return, a reasonable approximation may be made. The lease payments, excluding costs for services related to the accounting period, should be applied against the gross investments in the lease so as to reduce both the principal and unearned finance income. The estimated unguaranteed residual value used to calculate the lessor's gross investment in a lease should be reviewed regularly. If there has been a reduction in the value, then the income allocation over the lease term must be revised. Any reduction in respect of amounts already accrued should be recognized immediately. Initial direct costs incurred by lessors, e.g. commissions, legal fees, and other costs that are directly attributable to negotiating and arranging a lease, are included in the initial measurement of the finance lease receivable.
Okay, thank you very much. This is more or less like repetition of what we've discussed so far in our part 1, part 2, and part of part 3 of this session. Okay, Now, we are going to demonstrate this based on our understanding, and we're going to see it as we move on. But again, I want us to see a special nature of an asset that might be under lease. If a property is under lease, and you know that a property has two components, depreciable component, which is a building or structure, and the non-depreciable component, which is the land. How do we ensure appropriate treatment of land and building with respect to lease classification only from the perspective of the lessor? Can somebody take us through?
Okay. Special nature of classification of lease on property, i.e. land and building. Now, if the property is land and building, it can be separated into two, which is the first category is land, while the other category is building. Okay, under land, we may have operating lease unless title passes at the end of lease term. Under building, we have operating or finance lease. Implication. The implication is that allocation of equals to
allocation of, remember, even though under IFRS 15, we barely use the word minimum, but this is minimum, and you might remove the minimum away and put it like minimum lease payments. Go ahead.
Okay. Implication. Allocation of minimum lease payment equals to based on proportion of fair values.
Now, let me explain what we are saying here. What we are simply saying here is that the special nature of land and building, which is property as a rule, I'll describe these two as property. Now, a property has to be split into land and building, except categorically where title passes, which means there's a purchase option where the lessee will have to buy the property after the lease term. Except for that, land will always be classified as operating lease because of its indeterminable useful life. But if title will pass, land may now be classified as finance lease. Otherwise, it's only building that has that issue of looking at the attribute, whether it qualifies as operating or it qualifies as finance lease. And that is key. Now, where it is necessary, let's say land is operating, building is financing. Therefore, if the lease payment is, for example, $100,000 per year, you now have to ask yourself, this 100,000, how do we split it into the one that belongs to land and the one that belongs to building? What the standard provides as guardians is that we can look at the rateable value of the land and what the rent value of the building is, and let us use that to apportion this 100,000. And we can do that using the fair value or market value, price of the land and what is price of the building, and we'll use it to divide this. And on that basis, if we find out that this is 20,000 and this is what, 80,000, this will be treated as an operating lease, which we are going to see the treatment very straightforward, while this will form basis to obtaining the gross investment in the lease, which later on will be discounted to obtain the net investment in the lease. And that is just what I want us to have better understanding about. Now, let me now summarize. All things being equal, the summary or graphical summary of lessor's accounting for a finance lease can further be demonstrated in the charts I've put up below. Now, can somebody interpret this chart again? This chart also speaks to what we have discussed here. Okay. And also what we have discussed at this point here. At this point here. Okay, can somebody try to interpret this chart?
Summary of lessor's accounting for a finance lease. Initial recognition. Initial recognition can be divided into two. Now, during the initial recognition, we debit the lease receivables while we credit the cash or leased assets. Okay, under the lease receivables, we have net investment in the lease. The net investment in the lease can be categorized into two. We have the minimum lease payments plus unguaranteed residual value. Both these minimum lease payments and
I think the network is gone. Can you pick it up from there, Naro?
The net investment in the lease is broken into two, minimum lease payment and unguaranteed residual value. Both should be discounted, and that will give us the fair value and the initial direct costs. Okay.
Okay. Now we are going to look at that as we move on with a practical example. Okay. Let's look at a scenario. Okay, let's go back to this scenario we did earlier. Okay. I think it was scenario 9. Okay. Now, you know, we dealt with this scenario from the angle of the lessee. Okay, let's try to deal with it from the angle of the lessor. Let me come here and say lessor's accounting. Remember, this will have been treated as a finance lease from the angle of lessor's accounting. Who can tell me why? Because who can tell me why this will have been considered as a finance lease from the lessor's accounting? Look at some of the attributes here. Just pick one or two that will have shown that it's a finance lease from the lessor's perspective. Who will answer it?
Okay, I think they say the carrying amount of the ship is 8,000 and the fair value is 13,000. So basically, from the point of view of the lessor, the gross payments, total payment made will far more than substantially more than the carry amount of the asset. So that alone is fine there.
I don't think you are getting it right there. Who else can contribute? Okay, who will answer that? Now, let me give you first example. The ship was leased back for 20 what? Years. 20 years is a long years that has shown that even an average ship should not last more than 20 to 20-something years. And coupled with the fact that the ship has been used for some time and you still sold it and leased it back for 20 years, is a substantial part of the useful life. Does that make sense?
Okay, yes.
Second one is that the present value of the ship, present value of the lease, is significant to the fair value of the asset. How do I know? The present value is 11. What is the ratio of that to the fair value? This is about 91%. 90.6 exactly. Does that make sense?
Yes.
Which means if you go back to those conditions we identified, if you go back to those conditions we identify here, you can spot how many. Look at it. The lease transfer, okay, that was not there. The lease has option to purchase, that was not given. The lease time is a major part of the economic life of the assets, even if title will not be transferred. 2, at the inception of the lease, the present value of the minimum lease payment amount to at least substantial all of the fair value of the what? Lease asset. Does that make sense?
Yes.
Okay. That is that. Now, what do I want to drive at? The question then is, what is the gross investment in the lease? From our definition of gross investment in the lease, what is it? 1, gross investment in the lease is made up of 1, the lease payments. Receivable by the lessor under the finance lease. And what is the lease payment? How much are you to receive here? You are to receive 900.
Okay. For 20 years.
For what? 20 years. Therefore, 900 for 20 years is how much? That's 18,000. Is that not? 2, the unguaranteed residual value accrued to the lessor. In this case, we have no information of that. We put 0. Therefore, this sum up to 18,000. This is the undiscounted amount. This is what? Undiscounted total value consideration accruable to the lessor in a finance lease. That is that. Now, the next question is, what is
The
the
net.
net investment in the lease? It is the present value of the gross investment in the lease. And what is the present value?
It's 11,
It is
11, 11.7.
18,000. No, don't pick that because it might not be the same if you have variable changes here. 18,000
Okay.
multiplied by 1 plus R. What is R? Interest rate implicit in the lease, which is 5%. Raised to power, you discount this. Okay, it's cumulative discount now. Therefore, it will be, okay, let me do it like this. Let me just do it year 1. Yeah. One, 2, 3. It is 20 years, Abby.
Okay, I want to 20.
Okay. I'll just do 1 to 20. And year 20. Year 20 is the unguaranteed residual value. Remember, this is at expiration of the lease. That's why you obtain this. And this one is over the lease term. Therefore, let me describe it. Description. This is lease payments. And this is unguaranteed residual value. What are the cash flows? This is 900.
No,
Or how much?
900.
Yeah, per year. And this is 0. Therefore, my discount factor I put it in red, and my present value I put it in blue. What's my discount factor? Cumulative discount factor is 1 minus open bracket 1 plus R. My R is 5%. Raised to power minus 20, which is there, all divided by R. And if I convert it, that gives me 12.46. And this is just discount factor for one period, which is in period N. Therefore, what is my present value is a product of the discount factor and the cash flows. Therefore, I sum it up. And what do you have? That is it. Now, the difference between this and this is our unearned income. The question then is, what is the unearned finance income? The difference is the difference between the gross income and gross investment in the lease and the net investment in the lease. What's the gross investment in the lease?
18,000.
And the net investment in the lease?
11,215.99.
Okay. Now, any question on that?
But if we're not given the interest rate is implicit in this, we can easily use that in the other figure. That's the other present value. Or what's the essence of that present value?
Which present value?
There was this. Is it the present value of the?
This particular present value we did the other time?
Yes.
Okay, remember, okay, in this question, yeah, you can use the present value. I think in this question it's advanced, have you?
No, this is not advanced. So this
is advanced, yeah. It's advanced.
Okay,
Check.
the one up is advanced.
Yeah, therefore, if it's advanced, this is not going to be, it will be 1 to 19.
Okay.
Because it is in what? Advanced.
Advanced.
Now, if it's in advance, this is 19. Therefore, it will be 20 minus 1. That one period in advance. You know, I told you advance is associated with 1. Arrears is associated with 0. And anything minus 0 is still that thing. But anything minus 1 is less of 1. Okay. Remember, we now have period 0. That is the advance payment. Advance payment, that one will not be discounted. That is already at its present value. Discount factor here, 0 is 1. Therefore, When you sum it up, you should get the same thing. Do you get it now?
Yes.
Yeah. Now, this is done assuming all of what we have done here, assume that we are not, this is not a sales or lease back. I'm teaching this question. Okay, let me just copy this. Okay, wait. Let me shift it to 12. Okay. This assumes that there's no fair value. That is, we are not selling. It's not that they sold it to us and we are leasing back. This one is what we have and we lease it. You understand? Now, what now happened is this. Given that that assumption is not in place, the amount which represents the carrying amount of that item, which is the 13,000 we paid, will approximate our net investment in the lease. Which then means that what we have to do is that our net investment in the lease will not be 11,776, but rather it will be 13,000, because that is the price we pay in order for them to lease the assets for the next 20 years. Therefore, in that situation, what we are going to do is that the assets we have in our books at 13,000 will be recognized and immediately considered as the net investment in the lease. Because impliedly, let us ask ourselves, what will have been the interest rate implicit in the lease if what you have for 13,000, you have to lease it for 20 years and you have to collect 900 per year in advance? What will have been your interest rate implicit in the lease? Can somebody determine the interest rate implicit in the lease now? Let us determine that. Let me bring it forward here.
So are you not saying that we are going to use the gross?
Wait, let us determine something. What is the interest rate implicit in the finance lease by the lessor? That's the discount rate. Now I can use various functions. I'll use Excel rate function to determine that. Who can determine that for us?
We use IIR.
No, I said I want to use the rate function.
Rate function.
IIR will make me plug table. I don't want to plug table.
We go to the function cell. We type equals to rates, open brackets, then we look at the number of years,
20,
which is 20. We look at payments, which is 900. We look at the present value.
The present value is the 13,000 that I
13,000.
paid. The future value is 0. The future value is supposed to be the unguaranteed amount, which is 0. Let me put it here. Unguaranteed amount, which is 0. The type here, is it in advance or in arrears?
Is in
advance.
Advance 1.
Okay. Therefore, what is the interest rate implicit in the lease here? That's about 3.73. Now, if you check our question here, what they gave us here is from the perspective, this interest rate here is from the perspective, let me draw it back, is from the perspective of the lessee. Okay, which might be different from the perspective of the lessor. Therefore, in this case, this is interest rate implicit in the lease by the lessor. Now, let us use that. If we use that to determine our gross investment, you'll see that we arrive at that same 13,000. And what is that? I come here, discount factor. What is that factor? I change it from this cell to where is the cell? Yeah. Okay, what do we get?
We're getting 9.9 thousand.
No, there's something wrong there. When we use higher rate, we get lower value. When we use lower rate, supposed to get higher value. Okay, sorry, I didn't change this. Okay, yeah. I didn't change this. I was still using 5%. Yeah, can you see it there? Which means the interest rate implicit in the lease from the angle of the lessor is 3.73. Therefore, in that case, what accounting entry are you going to pass? Journal entries. The first one is upon purchase of the ship from the initial owner, which in this case is the lessee, because the person is leasing it back. What is the entry I'm going to pass? Remember my journal entry, debit credits. Therefore, what entry? Can somebody assist me?
Pass entry for the receivable.
No, when you purchase it, you debit your ship, which is your PPE.
Okay, purchase.
Property, plant, and what?
Equipment.
And you credit your what? Your bank. You pay 13,000. Is that not?
Yes.
Now, what happened when you lease it back? Upon lease back to the original owner, now the lessee as a finance what? Lease. What entry are we going to pass?
Okay, you're going to debit your receivable.
Now you are going to recognize the assets by go to that sheet.
Okay, credit it.
And you recognize your lease receivable. Therefore, you recognize this. Because the asset is no longer in your control, therefore, it is treated as if you dispose it off, but you are disposing it off at the same amount of the net investment in the lease that constitutes your lease receivable. Therefore, you dispose it off for this amount here, which constitutes the net investment in the lease. 13, and which is the same thing as the kind amount. And that is it.
Hello, Mr. Miwa.
Yes, sir.
I was expecting us to treat a question that solely relates to a lessor perspective. You know, this account, initially we looked at it from perspective of the lessee. Now,
Yes,
taking it round again.
Don't worry, we are coming to that. No, we are not looking at it from the perspective of the lessee. We are looking at it from the perspective of the lessor. The lessor bought the assets at how much? 13,000. That's the entry we have passed here.
Now, you know, you are looking at lease back, this back. I wanted to say, I would just go to a lessor accounting.
Just wait. Okay, let us listen, please. Imagine there was no lease back. Just imagine that you just bought the ship for 13,000 from somebody else.
Okay, before you lease
and you are leasing it. Yeah.
Okay.
And if you are not just buying it, you have it before the kind amount.
Yes.
You can say that's what we are saying. It's still the same thing. So let's make that.
Okay.
I'm just using one stone to keep two birds here, so that we don't just create another question from the scratch. Which means either you are buying the asset newly or you have it before. If you are buying it newly, the cost of the assets plus any other initial direct cost will constitute your lease receivable. If you have it before, the kind amount plus any indirect cost will constitute the lease receivable. That's what we are saying, sir.
That's true.
Now, which means at every point in time, the cost or the kind amount will be recognized as the lease receivable. Now, you ask me, can't it be different from the lease receivable? I'll say no, because your interest rate implicit in the lease, it is what you have worked back from what you collect over time to what the kind amount of the asset is, plus the unguaranteed residual value. Does that make sense?
Yes.
Which means at every point in time, it will be equal. The only exception is when we get to manufacturer or dealer, and we explain that separately. Now, this is it. Which means now, this receivable is what you have in your books. The asset is off your books. Now, you now have to construct amortization schedule. Let me look for an amortization schedule that I may have done before. Okay, I'll just pick this one. Okay, I think I did one, yeah? Okay, let me just pick this one. Amortization schedule, I'll do for year 1 to year 20. Okay, what is the value of the lease receivable?
Okay, 13.
13. Now, the lease payment is received in advance. Okay, therefore, the appropriate schedule I should use is the one we did in advance. Where's the one we did in advance? Okay, this. Can you remember?
Okay. Yes. That was the very first one.
Okay. Now, the interest rate implicit in the lease in this case is 3.73%. Okay, therefore I pick the value 13. Where am I picking it from? Yeah, I lock it. Now, each receipt I have was 900,000. This is the first one, year one. Other ones are in each year. Now, let me put it here. Okay, so that I consider the balance before I compute my interest. Okay. Now, my interest is computed based on the fact that as at the beginning of each period, I will have paid in advance, which means interest will not be computed on what I've paid on. And in that case, I have this, I sum it up, I drag it down. Now, what is my balance? My total balance is this. And I bring it forward. I do that up to the end of the period. Okay, I'll come back to the difference between this amount and what is payable next would be my non-current portion. Okay, now let me go back. And that is it. Now, as I've dragged it down, you've seen that this is my schedule. For it. And this was amended because it is payable in advance, such that interest is only computed after I've made that initial advance payment at the beginning of each of the periods. And that is that. Which means periodically, this is the interest I'll recognize. Which means in each year, accounting entry or journal entry A, finance income, will be for you to debit it will be for you to debit your lease receivable,
credit your finance income,
profit or loss with your interest income. With how much? This is year one.
Okay,
I'll just use year one as an example, and that's how you repeat it for each of those years. Second is your payment, cash received, lease payment received. From the lessee. The amount received from the lessee will be used to defray. Therefore, your bank balance will increase, your lease receivable will reduce. Which means in that case, what do you do? In year one, you defray. Whenever you defray, and this is at the beginning of year one, because it was in advance. If it's in arrears, it will be at the end of year one. But your interest is only accrued for at the end. Take note. And that's how you do it year in, year out, picking your figure from this table. And that is that. Now, your last cash flow year, any balance that is here will have more or less be as a result of your unguaranteed residual value, which means what you have here invariably will represent your unguaranteed residual value, if any. And I'll demonstrate it to you. Let me insert my line. This will be the unguaranteed Now, if you want to know, let us change our equation to say our unguaranteed is 100. Can you see it here? Does that make sense? The unguaranteed will now represent the current amount of that asset after the lease term that you would recognize from your lease receivable to your PPE, which means the asset revert to you at 100 naira.
Yeah.
That is it, which means I'll put that there at C. C is only, this one is each year, year 1 to year 20, have you? This one too is year 1 to year 20. But this is just year 20 alone. And what is it? It is the recognition of unguaranteed residual value being the carrying amount of the assets as it reverts to the lessor after the lease term. Therefore, what do? The entry be debit our PP.
Okay, credit receivable.
Now, it is now recognition, not the recognition. It will be the recognition for lease receivable, while it will be recognition for PPE. Does that make sense?
Yes. $100.
And that will be the 100 naira. And that will be end of year 20. Does that make sense?
Yes.
Yes, absolutely yes.
Okay, but because there's nothing, I'll go back here and say 0. Okay, now let's go back to our note to wrap it up. And that is all what we have explained. Everything here is what we have just explained. Okay, now let's look at from the perspective of, let's look at it from the perspective of a manufacturer or a dealer. Now for a manufacturer or a dealer, you know, first is into buying and selling. But what is into buying and selling is also leasing it, which means there are two things in one. One, the aspect of trading, and two, the aspect of leasing. Now, how do we treat that situation?
Leasing of assets.
Over to you.
Accounting for finance lease by manufacturer or the dealer as a lessor. IFRS 16 looks at the situation where manufacturers or dealers offer customers the choice of either buying or leasing an asset. There will be two types of income under such a lease. A, profit or loss equal to that from an outright sale, normal selling price less any discounts. B, finance cost over the lease term.
Sorry. Okay.
IFRS 16 requires the following treatments. A, recognize the selling profit or loss and income for the period as if it was an outright sale. B, if interest rates are artificially low, restrict the selling profit to that which would apply had a commercial rate been applied. C, recognize costs incurred in connection with negotiating and arranging a lease as an expense when the selling profit is recognized at the start of the lease term.
Okay, thank you. Now, before then, let's come back here. This is what we did subsequently. If you remember, this, I can copy it and take it back to our schedule, our model. this represents what we just did, yeah? Let me just put it somewhere here. These are the things we performed here with respect to finance income and issue of repayment of receivable. Okay, if you remember, and that is it. Okay, and how that impacted bank position. This is what we demonstrated here. Okay, let's go back. Now, from the angle of a manufacturer or a dealer, there are two activities in one. One, trading activity. This is trading activity. And this is leasing arrangement. Therefore, if everything is done at arm's length, the profit from the sale will be recognized immediately in profit or loss. And you treat lease as operating or finance lease as the case may be, but usually it's a finance lease in that situation. But the problem is this: what if it was not done at market rates, especially when the interest is artificially low? It is presumed that it is low because you have more or less factored the differential in the selling price, which means the selling price may have been overstated. Therefore, what do? You restrict the selling profit to what will have applied at a commercial rate, so that you will be able to use the difference that is not recognized to augment back the interest rate that was artificially low to what the market rate is. It is similar to what we have done before with respect to non-market rates for a sales and leaseback from the angle of the lessee. Finally, you recognize costs incurred in connection to negotiating and arranging a lease as an expense, and that is done when the selling profits has been recognized, which means instead of you to capitalize it as part of initial direct cost, you expense it along with the trading profit, because it is considered that such negotiation is tantamount to much more of ensuring you sell your assets in that regard. And that is the position of the standard. Okay, I think I have something here I can share with you further that probably summarizes it. One, the first part of it is this. This is the part that deals with recognition of the profits, selling profits. The second portion deals with issue of accruing for what? Finance income. Okay, now, given the fact that it might not have been done at commercial rates, I will show you a treatment that can be allocated to that. Okay, now any other question before we move further? Now let me try and, okay, any other question?
No question.
Okay, let's look at the final aspect, which is operating lease. If it's operating lease from the angle of the lessor, lessor's perspective, remember, we define operating lease from the lessor's perspective as a lease that does not transfer substantially all of the risk associated with the ownership of the assets.
Assets.
Okay, now how do we account for such? As I've said earlier, the accounting is straightforward. Okay, how straightforward it is, we are going to look at it with respect to certain examples. Okay, the accounting is that you continue to recognize that asset in your book without recognizing it, unlike what we did under finance lease. And any lease payment you have received in advance will be taken as unearned income and amortized at the end of each period. Otherwise, if it's lease that is paid in arrears, you accrue for it and you recognize it as income as at when due. And all of what you have done in that regard must be on a straight line basis. Now let's look at it from this angle. I want to shift it up. Okay, can somebody assist me here to read out the accounting treatment for operating lease?
Okay, accounting treatment of operating lease. An asset held for use in operating leases by a lessor should be recorded as a long-term asset and depreciated over its useful life. The basis for depreciation will be consistent with the lessor's policy on similar non-lease assets and follow the guidance in IFRS 16. Income from an operating lease, excluding charges for services such as insurance and maintenance, we recognize on a straight line basis over the period of the lease, even if the receipts are not on such a basis, unless another systematic and rational basis is more representative of the time pattern in which the benefit from the lease asset is receivable. Initial direct costs incurred by lessors in negotiating and arranging an operating lease should be added to the carrying amount of the leased asset and recognized as an expense over the lease term on the same basis as lease income, i.e., capitalized and amortized over the lease term. Lessor should refer to IAS 36 in order to determine whether a lease asset has become impaired. A lessor who is a manufacturer or dealer should not recognize any selling profit on entering into an operating lease because it is not the equivalent of a sale.
Okay, thank you. Now let's look at an illustration that will buttress our understanding of this. Okay, as I've told you, it's very straightforward. And how do you account for it? Can you read this question and let us look at how it was being accounted for?
Okay, illustration. AFACO leases a machine with a remaining useful life of 10 years to BetaCo. The lease commenced on 1st January 20X1 and is for a term of 3 years. Lease payment of $3,600 are due on 31st December each year. As an incentive, BetaCo was given a rent-free period of 2 months at the commencement of the lease. AFACO is responsible for maintenance of the machine. Required, discuss the accounting treatment of the above lease in the financial statement of AFACO for the year ended 31st December 20X1, including relevant calculations.
Okay, can you discuss that?
Okay, BetaCo is the lessor, So basically, the question says that the item has a useful life of 10 years, but it leases it for a term of 3 years for a payment of 3,600 every year. So I think what this means is that at the end of every year, the alpha co will depreciate the asset on a straight line basis normally. Then we recognize any lease payment received as lease income. I think that is it.
Okay, can you read the solution now?
In addition to that illustration, I think there is 2-month concession that will be recognized as rent-free in our solution.
Now, even when it is rent-free, will you still not accrue for it?
It will still pay for it now.
No.
Yes, we accrue for it.
No, it will be
not
paid.
paying, but
It's
we
not paying, but you accrue
calculate
for
the
it.
monetary value.
Yeah, what you would do in that regard is that if somebody is supposed to pay $1,000 per month for 4 years, that should have been $48,000. But you are saying that your first, let's say your first 3 months is free, which means the first 3 months you will not pay, but that doesn't mean there's no income. What we now do is that out of $48,000, you are given discount of $3,000. That is what it means. It means what is left is $45,000. You will now divide $45,000 by 48 periods in order to recognize each month. Does that make sense?
Okay, yes.
Which means even though you are receiving payment of 45 months, but it relates to 48 lease periods. Therefore, anything due for you in 45 payment must be amortized on a straight line for 48 months. Does that make sense now?
Yes.
Okay, Nudin, can you read the solution?
Okay, Alpha Co retains the risk and rewards of ownership of the machine, evidenced by the fact that the lease is only for a small portion of the useful life of the machine, and the fact that Alpha is responsible for maintenance of the machine during the lease term. As such, the lease is an operating lease in the financial statements of Alpha Co. The benefit received from the asset is earned over the 3 years of the lease. However, in the first year, Alpha only receives $3,600 multiplied by 10 divided by 12, which is $3,000. Lease rental of $10,200, which is $3,000 plus $3,600 multiplied by 2 years are received over the 3 years lease term. In accordance with IFRS 16, Alpha should recognize income of $3,400, that is $10,200 divided by 3 years. In the year to 31st December 20x1, and in each of the following 2 years, a receivable of $400 should be recognized at 31st December 20x1. That is $3,400 minus $3,000 cash received.
Thank you very much. Now, let's wrap it up with subleases. You are a primary lessee and you now lease it out to another person. Which means you are a lessee to someone on an asset and partially or fully you are a lessor to another person. How do you account for that? Can you read it out and let me explain it very shortly?
The sub-leases.
Sub-leases. A lessee L may sublease, a lessee L may sublease an asset, which is in turn leases from another lessor, H. In the situation where H is the head lessor, who ultimately owns the asset from a legal perspective, L then becomes an intermediate lessor. An intermediate lessor must assess whether the sublease is a finance or operating lease in the context of the right of use assets being leased, not the actual underlying assets. Example of sublease. This example is adapted from illustrative example 18. Interlease enters into a 10-year lease for 6,000 square meters of office space, the head lease, with head lease, the head lessor. At the beginning of year 5, Interlease subleased the 6,000 square meters of office space for the remaining 6 years of the head lease to a sublease solution. In this situation,
just wait. I'm trying to draw something for you here. This is the head lessor. This was a lessee turned a lessor. And this is a sub-lessee in this situation. Okay, and that is that. Okay, now, in this question, we said, Interlease entered into a 10-year lease for 6,000 square meters of office space. That was the person that first of all had the lease with the head lease, which is this. Interlease is this. At the beginning of year 5, which means 4 years after, he has already been using the asset for 4 years. The lease is for 10 years, but at the beginning of the 5th year, which is 6 years to go, he decided to sublease it to another person. And this person's sublease is this. How do you account for it? Very simple. In this situation, the head lessor, which I've identified, is the head lease. The intermediate lessor, which is the lessee turned lessor, is the interlease, and sublease is the sublessee. From the perspective of the intermediate lessor, that's what we're interested in now. At the time of the sublease, when he entered, the right of use asset has 6 years remaining, and it's been subleased for the entirety of the remaining period. As such, that sublease is a major part of the useful life. Therefore, you are going to classify it as a finance lease. There is no business of the head lessor in it. It's account for it as if there was nobody leasing it out. Okay? But from the angle of the lessee, at the end of year 4, he now recognize the right of use and replace it with lease receivable and account for it as finance lease, because the new lessee will substantially use the remaining useful life or the remaining lease term, which is 6 years, in order to fulfill his consideration for the sublease. And that is that. Any question on that? Which means, even as a lessee, when you lease part or all of that asset, you need to examine whether it is a finance lease or an operating lease, because you have now become a lessor, but an intermediate lessor rather than the ultimate lessor. Any question?
Now, well, I think in practice, some of these things, I think in my company, we have this situation where we sublet a property to others, but the way we accounted for it was so straightforward. More or less like an operating lease. We just recognize more or less like an operating lease, because we just take the portion of the difference between the amount we pay to the lessor and what the sub-leasee pays to us, and recognize the difference as an income for the period. Though is on a accrual basis, so each year we accrue for it. So the portion that we are supposed to have paid to the lessor at the portion of the year that the lessees or the sub-lessees also pay to us, the difference we just take it as income. That's what we do. Treat it straightforwardly. We are not why. That's what we did.
Proper accounting is not about straightforward. It's about, are you depicting the right financial performance and the right position relating to that transaction? It's not about straightforward. You understand? What this has exposed you to is to revisit the way and manner to which you will report your transaction with respect to sub-leases. Does that make sense?
That's true.
Okay. Now, what I've also done is that from the standard, I've copied out, probably I will allow you to read it up. I've copied out what you need to disclose with respect to leases. Okay, can you read it out, please?
Finance leases. Okay, disclosure expert.
Yeah.
Shall provide a qualitative, disclosure. The objective of disclosure is for lessors to disclose information in the notes that, together with the information provided in the statement of financial position, statement of profit or loss, and statement of cash flows, gives a basis for users of financial statements financial performance and cash flows of the lessor. Paragraph 90 to 97 specify requirements on how to meet the.
Since your network is bad, Nuruddin, can you start it all over again, please? Let's wrap it up.
Disclosure. The objective of the disclosures is for lessors to disclose information in the notes that, together with the information provided in the statements of financial position, statement of profits or loss, and statement of cash flows, gives a basis for users of financial statements to assess the effect that leases have on the financial position. Financial performance and cash flow of the lessor. Paragraph 90 to 97 specify requirements on how to meet this objective. A lessor shall disclose the following amounts for the reporting period. A. For finance leases. 1. Selling profits or loss. 2. Finance income on the net investment in the lease. And 3. Income relating to variable lease payments not included in the measurement of the net investment in the lease. B. For operating leases, lease income, separately disclosing income relating to variable lease payments that do not depend on an index or a rate. 91. A lessor shall provide the disclosures specified in paragraph 90 in a tabular format, unless another format is more appropriate. A lessor shall disclose additional qualitative and quantitative information about the leasing activities necessary to meet the disclosure objective in paragraph 89. This additional information includes, but is not limited to, information that helps users of financial statements to assess A, the nature of the lessor's leasing activities, and B, how the lessor manages the risk associated with any rights and retains and underlying assets. Any right it retains in underlying assets. In particular, a lessor shall disclose its risk management strategy for the rights it retains in underlying assets, including any means by which the lessor reduces that risk. Such means may include, for example, buyback agreements, residual value guarantee, or variable lease payment for use in excess of specified limits. Finance leases. A lessor shall provide a qualitative and quantitative explanation of the significant changes in the carrying amount of the net investment in finance leases. A lessor shall disclose a maturity analysis of the lease payment receivables, showing the undiscounted lease payments to be received on an annual basis for a minimum of each of the first 5 years, and a total of the amount for the remaining years. A lessor shall reconcile the undiscounted lease payments to the net investment in the lease. The reconciliation shall identify the unearned finance income relating to the lease payment receivable and any discounted unguaranteed residual value. Operating leases. For item of property, plant, and equipment subject to an operating lease, a lessor shall apply the disclosure requirements of IAS 16. In applying the disclosure requirements of IAS 16, a lessor shall disaggregate each class of property, plant, and equipment into assets subject to operating leases and assets not subject to operating leases accordingly. Accordingly, a lessor shall provide the disclosures requirement by IAS 16 for assets subject to an operating lease by class of underlying assets, separately from owned assets held and used by the lessor. A lessor shall apply the disclosure requirements in IAS 36, IAS 38, and IAS 40 and IAS 41 for assets subject to operating leases. A lessor shall disclose a maturity analysis of lease payments showing the undiscounted lease payments to be received on an annual basis for a minimum of each of the first 5 years and a total of the amounts for the remaining years.
Okay, all what we have looked at is from the perspective of the lessor. Now, what are you to disclose from the perspective of the lessee? Can you read that out? Over to you.
Disclosure requirement, perspective of the lessee. The objective of the disclosures is for lessees to disclose information in the notes that, together with the information provided in the statement of financial position, statement of profit or loss, and statement of cash flows gives a basis for users of financial statements to assess the effect that leases have on the financial position, financial performance, and cash flows of the lessee. Paragraph 52 to 60 specify requirements on how to meet this objective. Paragraph 52. A lessee shall disclose information about its leases for which it is a lessee in a single note or separate section in its financial statements. However, a lessee needs not duplicate information that is already presented elsewhere in the financial statement, provided that the information is incorporated by cross-reference in the single note or separate section about leases. Paragraph 53. A lessee shall disclose the following amounts for reporting period. A. Depreciation charge for rights of use assets by class underlying assets. B. Interest expense on lease liabilities. C. The expense relating to short-term leases accounted for applying paragraph 6. This expense needs not include the expense relating to leases with a lease term of 1 month or less. D. The expense relating to leases of low-value assets accounted for applying paragraph 6. This expense shall not include the expense relating to short-term leases or low-value assets included in paragraph 53C. Paragraph 53E. The expense relating to variable lease payments not included in the measurements of lease liabilities. F. Income from subleasing rights of use assets. G. Total cash outflow for leases. H. Additions to rights of use assets. I. Gains or losses arising from sales and leaseback transactions. And J. The carrying amount of rights of use assets at the end of the reporting period by class of underlying assets. Paragraph 54. A lessee shall provide the disclosure specified in paragraph 53 in a tabular format unless another format is more appropriate. The amount disclosed shall include cost that a lessee has included in the carrying amount of another asset during reporting period. 53. A lessee shall disclose the amount of its lease commitment for short-term leases accounted for applying paragraph 6 if the portfolio of short-term leases to which it is committed at the end of the reporting period is dissimilar to this portfolio of short-term leases to which the short-term lease expense disclosed applying paragraph 53C relates. 56. If rights of use assets meets the definition of investment property, a lessee shall apply the disclosure requirements in IAS 40. In that case, a lessee is not required to provide the disclosures in paragraph 53A, F, H, or J for those right of use assets. Paragraph 57. If a lessee measures right of use assets at revalued amounts applying IAS 16, the lessee shall disclose the information required by paragraph 77 of IAS 16 for those rights of use assets. Paragraph 58. A lessee shall disclose the maturity analysis of lease liability applying paragraph 39 and B11 of IFRS 7 financial instruments disclosures separately from the maturity analysis of other financial liabilities. Paragraph 59. In addition to the disclosure required in paragraph 53 to paragraph 58, a lessee shall disclose additional qualitative and quantitative information about its leasing activities necessary to meet the disclosure objective in paragraph 51, as described in paragraph B48. This additional information may include, but is not limited to, information that helps users of financial statement to assess A, the nature of the lessee's leasing activities, B, future cash outflows to which the lessee is potentially exposed that are not reflected in the measurements of lease liabilities. This includes exposure arising from 1. Variable lease payments as described in paragraph B49. 2. Extension option and termination option as described in paragraph B50. 3. Residual value guarantee as described in paragraph B51. And 4. Leases not yet commenced to which the lessee is committed. C. Restriction or covenant imposed by leases and the sales and leaseback transaction as described in paragraph B52.
Continuation. You are muted.
Paragraph 60. A lessee that accounts for short-term leases or leases of low-value assets applying paragraph 6 shall disclose that fact. 60A. If a lessee applies the practical expedient in paragraph 46A, the lessee shall disclose A, that it has applied a practical expedient to all rent concession that meet the conditions in paragraph 46B, or if not applied to all such rent concession, information about the nature of the contract to which it has applied a practical expedient, see paragraph 2, and B, the amount recognized in profit or loss for the reporting period to reflect changes in lease payments that arise from rent concessions to which the lessee has applied a practical expedient in paragraph 46A.
Okay, thank you very much. This brings us to the end of all of our discussions in part 1, part 2, and part 3 as regards leases. Thank you very much, and God bless you all.